The Mortgage Bankers Association recently reported that loan applications for new home purchases plummeted by 14%, the biggest decline since May of 2010. This followed an earlier release saying that profits per loan fell almost 25% because of rising rates. So what do these things mean for mortgage bankers operating in a market still suffering from sluggish home sales, falling prices, and more than 1 million foreclosures? Joining us now to talk about this, David Stevens. He is CEO of the Mortgage Bankers Association and a former assistant secretary for the U.S. Department of Housing and Urban Development. So, David, thanks for joining us. We appreciate you stopping by here. Let's talk about the numbers that we got last week. I mean, mortgage applications down 5.6%. For new home purchases, 14%. What does that mean to you as far as this market? It doesn't sound like a recovery.
Well, look, if you look at the markets, we've been sort of bumping along numbers along this range for quite some time. We're seeing increases and decreases. A lot of it is interest rate related. Consumer confidence can ebb and flow, but we're still not seeing significant price declines. Most forecasts predict just maybe a few percentage points more of decline. So I think it's really important for us to be looking at sort of longer-term trends than week-by-week or month-by-month statistics. But without question, the numbers are dropping. And fundamentally,
the price chart looks like a double dip right now, right? I mean, we're back below the low that we were during the crisis.
Yeah, so I wouldn't. I'd be cautious about using the double dip. And let me just give you a couple key points to think about. One is refinancing we expect to decline anyway. We expect the mortgage market to go from about $1.5 trillion last year to perhaps around $1 trillion in the next year and a half or so on a run rate level. So we are going to see the overall mortgage application market decline. On the home purchase side, I think that's a variable we need to look at very closely. Without question, we are seeing some slowness. There's no doubt about it. But we need to go through some trends. Oil prices, unemployment, what's happening generally with the economic environment broadly. Those are going to have significant impacts on what we start seeing with home buyers, because demand is going to have a lot to do with consumer confidence as well.
What does this mean? I mean, for you as president of the Mortgage Bankers Association, how are mortgage bankers doing right now, right? If profit fell a quarter because interest rates are creeping up already, and we expect them to continue, there's only one way for interest rates to go, right? What does this mean for mortgage bankers right now?
I started in the business when interest rates were 18% long time ago, and people were buying and selling homes. This is a cyclical industry. Without question, there's going to be some contraction going on right now. It has to. Operations have to contract, particularly as the refinance market goes away. The question is, at what pace and how quickly will the purchase market show growth? We've seen delinquency rates declining since the first quarter of 2010. We're seeing new foreclosure starts declining. And we're seeing the variable between rent versus own, that affordability index, is reaching all-time highs in terms of the affordability of owning a home. So my expectation would be, while slow, that we will continue to see, on a long-term basis, home sales growth begin to kick up. It's just a question of what happens here quarter by quarter.
How do foreclosures play into that? You say you're seeing foreclosure starts declining. Aren't there a lot more waiting in the wings out there?
These are foreclosure starts. So there are foreclosures. There's clearly an inventory issue. People talk about the overhang. Those will wash themselves through the system, either through recovery, through either loss mitigation programs or foreclosure prevention programs, or perhaps ultimate foreclosure for many. But the real numbers we look at are new foreclosure starts, first-time filings of new foreclosures. That's a key variable when you break down the foreclosure data to find out what's the inventory we're dealing with. Is it past inventory from delinquencies that started a year or 2 years ago, or is it current new defaults that we're having to deal with in today's market? And the good news is the data on new defaults, first-time filings, is going down.
Let me quickly ask you about interest rates again, because a lot of people assume that when interest rates come down, people will go and flood out and buy homes, right? And when they go up, people will stop. But how much do you find that the rate movements really affect people's decisions to buy homes? Because obviously other factors, marriage, babies, affect that as well.
Well, look, there's going to be a natural transition that occurs economically, somewhere in the 15% range in terms of transition of home ownership on an annualized basis, irregardless of rate. Rates clearly drive a couple of behaviors. One is, most Americans who own a home who have been making their payments when rates dropped to the 4% range, they took advantage of that and refinanced their home. So you're going to see a lot of activity to improve your cash flow when that happens. If rates rise, there clearly has to be some room between a market today that's at 4, and if rates go to the mid-5s, we're still at rates that are near record lows, historically speaking. And so the question is affordability, consumer confidence, unemployment. Those variables are going to be the big drivers.
Got it, David. Thanks so much for joining us today. David Stevens there.